Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your monthly trending report for the month of August of 2025. You know, for this month, the theme and really the message is the same as the last several. It is so interesting to watch the stock market and how it relates to the economy. You know, at 52 years old and 30 some years maybe of paying attention to the stock market, the one thing that remains constant is uncertainty. Sometimes that uncertainty is caused by politicians. Sometimes it's caused by pandemics. Sometimes it's caused by the economy itself. But uncertainty is the one constant that we seem to have to battle. And you know, right now is no different. And that's where the theme and the message is so similar. I almost feel bad that we're talking about the same thing month after month, but hopefully today you'll see a different visual to talk a little bit about the same thing. But first of all, to bring you back to that cycle of investor emotions. Where are you in this cycle right now? Because to me, and maybe this is just my personal interpretation of how I feel about what's going on in the stock market, but my emotions seem to be switching pretty quickly. They seem to be switching from the fear and desperation to the hope and relief almost every other day. I know, we talk about being unemotional when it comes to investing, and I've said this multiple times. I am probably one of the most emotional investors there can be on the planet because this is on my computer screen every day. The stock markets, investing, long-term, all of that goes through my head every day, but especially since it's my job, it's on my screen every day. And so every day, depending on what I see in front of me, whether that's headlines or the market itself or individual stocks that I follow, my emotions see this cycle probably way too often. And so there are days where I feel that fear and panic, and I almost capitulate. And there are also days where I'm so hopeful and so relieved and so optimistic that I'm trying to find where else can I get money from in my own accounts to invest more. And you might feel that too, to a certain extent. Whether as an advisor or as an investor, it's hard for us when the markets are moving so quickly, when things are so volatile, when the news cycle changes so quickly. It's hard to stay the course. It's hard to remember that long-term investing and long-term success don't just require long-term planning, but it requires a commitment to the plan. And so I'll say this as we go further into our conversation. As I've said before, a long-term plan only works if you see it through to the long term. Of course, there are adjustments. Sometimes changes need to be made, but the frequency of changes is where we see people getting into trouble. And so as we sit here in August of 2025, the last 9 months have been a roller coaster of emotions. The market has been volatile. But the stock market is also up year to date around 9 to 10%. And I think for most of us in January of 2025, if you would have told us, listen, things are going to get crazy, but by the middle of August, The S&P 500 is going to be up about 10% for the year. Would you take that? I think most of us would have said yes. The problem is it didn't start at 0 and go straight up to 10. Performance never happens in a straight line. And that's why this cycle of investor emotions is so important. It's important for you to realize where you are in this cycle. Just a little example of that. We had the good fortune last week of going on our family vacation. We've made it an annual thing where we go up to Northern Michigan that first week of August, and we get as much sun as possible. We get as much time in the water as possible. And of course, we get as much family time as possible. By Thursday afternoon, 4 or 5 days in the sun, I know that I'm tired. I know that I have put myself through things that I don't normally do. 8 hours in the sun is not normal for me. I'm normally inside of an office, inside of a cubicle. To do that 4 days in a row is awesome. But I often also have to recognize that by Thursday afternoon, I'm tired. And because I'm tired, my emotions can be volatile. And so actually on Thursday afternoon, I had to say to my stepson, hey, just so you know, I'm tired. And I'm going to need help when we dock the boat. And I need you to be patient with me because I may not be patient with you. You have to recognize your own emotions to successfully communicate and work with other adults. You have to recognize your emotions when it comes to this stock market and this economy. And so one of the things that I wanted to do this month, was look at what are other people doing? What does it look like in terms of money movement in the market? Because remember, it's not just the price of companies, and it's not just the price of stocks. It's how other investors are interacting with the fund world. So what you're looking at here are the fund flows, specifically of U.S. equity sector funds over the course of the past 3 weeks. Every week, there's a record taken of the money that goes in and out of sector-specific equity funds. And what you see here on your screen is really interesting. You can see from week to week where money is going and maybe where it's leaving. So the first one, the big orange line on the right-hand side is communication services. A lot of money going in for last week as of 8/6/2025. But just the week before, it had net outflows, money leaving. And the week before that, there were inflows. You see on the screen the sentiment of investors and advisors on a weekly basis, and you can see how really inconsistent it is. So just to read a couple things so I don't get them wrong. U.S. large cap funds witnessed a robust $14.06 billion worth of outflows, the biggest weekly outflow last week in 6 weeks. Investors also pulled out $3.94 billion, $1.48 billion, and $1.26 billion from U.S. small cap, multi-cap, and mid-cap funds. Money leaving those funds. Sector funds, which is what we're looking at on the screen, meanwhile attracted inflows for the first time in 9 weeks. The financials and consumer staples sectors saw a notable $502 million and $433 million worth of net purchases. So money moves. And when money moves, that obviously, it's not just moving because of the market, but money moving can affect the market as well. If you watch the financial news on a daily basis, what you see is talking heads talking about what to do today. How do you make money today? What trades should you make today? How do they feel about certain companies and certain stocks today? A long-term plan has to weather all of that noise around it. And it also has to weather some of the moves of money flowing in and out of different sectors and investments. Now, the other thing I think that's interesting is the fund flows for US bond funds. Because what you see here too is you see that, just at a glance, the more money that goes into US bond funds, the more uncertainty typically there is in the market. Stocks are for speculation. Bonds are typically for preservation. And so what you see here is you see some of that preservation over the last month. So in terms of US bond funds, they saw second successive week of inflows. By segment, US municipal debt funds and US mortgage funds attracted a significant 1.57 billion and 967 million of inflows. So it's interesting to see what other people are doing in terms of investing. And what you see is you see a lot of activity. But activity for activity's sake is not what we're trying to do. As I've said before, short-term emotions kill long-term plans. If your plan was good when you set it up, it should still be good today. Again, it doesn't mean adjustments don't need to be made, but they should be minor adjustments. They shouldn't be wholesale changes. And so as we look to the trends over the last month, what we see again, just on a 1-month basis in the S&P 500, is we see this volatility. Now, if you've been paying attention to the headlines, you know that this massive dip really on August 1st, that was the day that many of the tariffs went into effect. It was that final deadline for most of the countries. And again, in anticipation of bad things happening, there was a lot of selling pressure on August 1st. And based on selling pressure, the market went down. If you think about it, nothing happened on August 1st, except that the tariffs went into effect. A pond doesn't ripple when the stone you throw into it is still in the air. It ripples once it hits the water. So what happened after August 1st when the tariffs went into effect? And this is so much of what we've seen this year. The anticipation of bad things happening is making the market move more than bad things happening. Look what happened since the tariffs went into effect on August 1st. For the rest of the month, still volatility, but it's been up. That's why it's so important not to change your plan based on what you think might happen today. And the overall trends support this. What we see over the course of the past trailing 12 months, we were at a high right near the end of March. And again, what we had was anticipation of tariffs disrupting the marketplace. And based on that anticipation, selling started to happen and repositioning started to happen. And it became a tumbling effect where we saw the market fall. As we continue to battle through these changes in American trade policy, what is the market doing? It's adjusting. One of the things that I read recently was about the supply chains and how supply chains have had to adjust to the threats of tariffs, the actual tariffs, and where and when major companies are buying their supplies from overseas. And the interesting thing that I read was because of the reaction to COVID. Many of these companies already streamlined their supply chains. They already had to react to 2020, which prepared them to react to 2025. And so it's been interesting to see, again, the ripple of what the tariff consequences are. Now, we're not through them yet, but the initial, like I said, the initial reaction to tariffs or anticipation of tariffs has been worse than the actual reaction. But if we're looking at the long-term trends, the longer-term trends seem to support the idea that some sort of exposure to the stock market is appropriate. And so I want to talk about formulaic investing. And I want to talk about this unemotional, disciplined approach to the marketplace. Because the one thing when you're using formulas and you're using indicators, those indicators and formulas, they don't watch the news. They watch the market's reaction to the news. And sometimes an indicator will get defensive based on how the market has anticipated what will happen to it. And so over the course of this year, some of the formulaic money managers you may be using may have gotten defensive when they didn't need to, or stayed defensive longer than they should have. Well, that doesn't mean that the formula is not working. It means that in the current market conditions, it's reading the markets and it's not reading the overall economic conditions, and that's normal. That's why we're such huge proponents of using multiple managers that manage money in different ways at different times. But the long-term strategy should still make sense. And so as we talk in August of 2025, with several months left to go, a finish up of the third quarter and the fourth quarter yet to go in 2025, market volatility, if we've allowed the money managers to work the way they should, still has the chance to be our friend. But navigating volatility is not a certainty. It is not a guarantee. And when we have these uncertain markets, it's important to review the plan and to make sure the plan is still working the way it should. Because long-term plans only experience success if they're not changed over the short term. This is Kevin Roskam with USA Financial. This has been your August Trending Report. Thanks for listening. We'll see you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.